So this week you join us at an interesting time. I am about to jump in a taxi to go to the airport, and Steve Keen in Sydney, going back to the UK, and Steve Keen is in Bangkok, having literally just woken up, having slept through his alarm, while I was getting increasingly irate because he didn't meet his time that we were supposed to get together. So that's why I look a little bit angry, and Steve looks a bit like he's just woken up, because he has. So anyway, there we are. That's how you find us this morning. So today I thought, given that there's war going on, let's not talk about that at all, because I read a paper, Why I Don't Know, by Andrew Bailey. Here it is. All about the independence of central banks, which has proved to be very useful, because on here you can see I've drawn up the dimensions of the lift in the building I'm in, so I can figure out whether I can get a bed to fit it. That's how useful this paper's been so far. But Steve, the idea of this paper from Andrew Bailey, who is of course the governor of the Bank of England, he was talking at a Columbia University this week. He wants central banks to have more independence, and the basis of his argument is that central banks are important because governments want to have stable pricing. Well, we all want to have stable pricing, and they're the only ones who could do that, because if a government was given the ability to perform the monetary role of a central bank, then they would be tempted to say, well, we'll just have a little bit of extra inflation so that we can reduce unemployment, or we can ease our debt burdens, and so they wouldn't have the staying power to do what is the right thing. That's his argument. We've talked quite a bit, haven't we, about whether actually the role of an independent central bank sits at odds with the role of the government, because they are trying to do, they're trying to head in the opposite direction from each other. His argument is, well, you've got to have that, otherwise governments will just create inflation, because they'll try and do what is politically popular to try and get growth in the economy, like Donald Trump's trying to tell the Fed that they should drop interest rates, where most economists would say, well, actually, there's a risk of inflation, they should be lifting interest rates. Where do you sit on that?
Well, it's actually the exposure of the fallacy of mainstream economics for the last 4 decades, because they have, without, of course, telling the politicians, they've persuaded themselves that fiscal policy is ineffective. There's actually one of the major papers in academic economics is called the policy ineffectiveness proposition. And they argue that because people know what the government's going to do, I'm not joking, the government itself doesn't know what it's going to do, but this is the policy discussion amongst economists. Because people know what the government's going to do, they cannot be fooled by the government for even one period, quote unquote, from that particular paper. So economists have been deliberately undermining fiscal policy internally. It isn't just that they act at odds. They believe that there should be no government policy. It should all come down to controlling the interest rate. Now, that, of course, has been so wildly successful that we are having this conversation.
Yeah. Well, there's another dimension to what he says, which you might have more acceptance of, or maybe not, and that's the other role of a central bank, which is financial stability. So there's stability
pardon me.
There's stability in the value of money, but then there's all the role of financial stability as well. And he argues the same thing, that a government might be tempted to lower standards to increase growth because of lobbying. Well, but actually we do see that happening, don't we? So we go through this cycle where the banks are too easy on credit. They give away too much credit. We get an asset bubble. And so central banks tighten the ability for banks to lend out quite so much money. And then we go through a period where that doesn't happen. And so the banks and everybody else, all other interested parties, lobby the central banks to ease those regulations so that they're more free with the lending out of money. I mean, that does happen.
Yeah, but we're talking fantasy.
Right.
And this is why it's so difficult, because we're wondering why fantasy doesn't work in the real world. That's fundamentally what we're doing. Why, there I am. I've said my incantations. I've played with the plasticine figures. I've worn the upside down the helmet on my head. Why haven't inflation rates fallen? Okay, and I'm afraid that's exactly what's going on here. Because economists are operating with a completely false model. of how the economy functions. And then they're saying, why didn't it work? Because you're using the model which is fallacious. How many times do we have to tell you? But that is what's going on. So they have a model in which the reason, I mean, I'll go back to that quote I took from that paper on the policy and effectiveness proposition. I said, there was a word inside there which should have people screaming, and that is no. Okay? The reason you should scream about the word no, not N-O, but K-N-O-W, is that they say we know what's going to happen in the future. Because the public policy knows the policy, because the public knows the policy of the government. So they're literally saying there's no uncertainty about the future. Now, that is ridiculous. So what we have is we have an instrument, the central bank, which does have some definable impacts upon how the economy operates, which we could then set into a set of policies. However, we have a bunch of economists who've got theories about what the central bank does that leave out the primary functions of the central bank and then say by increasing the interest rate, we can reduce the rate of inflation according to our model of the real world, which anybody who hasn't been deluded enough to think that people can predict the future knows is nonsense.
So this paper is actually focusing a little less on the monetary side of things, and we'll go back and revisit that in a second. But it is more about how you keep the controls on bank stability so two roles of central banks. Obviously, one is supposedly stability of the value of money, and the other one is stability of the whole
financial system itself.
Yeah. So, and the objective of each of those should be pretty similar, shouldn't it? In that we don't want them to move too much. We don't want. We want the currency to be meaningful so that people can use it in a meaningful way and understanding its value isn't erratic. And similarly, we want people to be able to exchange money without, the mechanism they're using for that exchange, the bank that they're using, suddenly collapsing around them. So, so someone's got to do that. And if it's not a central bank, who does that? And out of the two of them, probably the hardest one is that ensuring that financial stability, because, a point made by Andrew Bailey is when it's really working is when nothing happens.
Exactly.
And so how do you measure whether they're doing a good job or not? Well, it's because nothing is happening.
Well, this has got a long history with the central banks. And you probably know one of my favorite books on economics is by John Black called Dynamic Economic Systems. And as part of that, he goes through the 19th century, the history of the 19th century in the UK, and covers all the financial crises and that happened in the 19th century. Now, one thing which really annoys me, even more so than me sleeping in and ruining the start of our recording, is that economists don't learn from history. Because if you take a look at that history, the belief that the government should pass laws that leave the market system to reach its own equilibrium is quite long. It predates neoclassical economics. It goes right back to the 1700s. So the attitude we've had that the government should leave the franking system alone and let it meet its proper level has been it's been how politicians approach the government all the way through. So there are sets of laws passed. I've forgotten the actual names. But there were sets of laws passed that were like the Currency Act, I think they were called. And they were basically saying that under no circumstances should the central bank rescue a private bank which has failed. Let the market rule. The bank didn't survive in the market, it should fail.
Yeah.
No thought whatsoever of consequences of when one part of the system fails. How did the rest of the system behave?
The contagion behind that. But I mean,
they were forced to break their own law on 2 occasions in the 19th century. Okay?
Because of contagion.
The crash was so bad that the economy was breaking down, and they finally realized the only way we can liberate this is by the Bank of England issuing notes to help replate the system. Okay? So rather than hands off, they had that hands on. It was a bit like if you want to have an analogy that makes sense, it's like doctors having rules about when you don't do an operation in the operating theatre. Okay? And then you say, oh shit, the patient is dying. Let's ignore that rule and revive him. And this was a regular reality. So the belief the economy is self-regulating to begin with, or the belief that the public knows what the government is going to do and therefore they cancel the behavior of fiscal policy, none of this stands up by any stretch when you look at the historical data. So we should be saying, okay, we have the instrument. Is there a way in which it can behave that can add to stability? Is there a way it can behave which could reduce the monetary pressure that's giving us inflation? And none of this gets done because the people who make the policies don't read history. They read their own academic papers from mainstream economists, and those papers are basically in a fantasy world in which simply by putting up the rate of interest you do cause inflation to fall. But we live in the real world, and those policies haven't worked.
But that issue around stability, though, so that initial idea that we should just leave banks to it, I mean, the argument for that obviously is that if banks collapse, people understand the value of risk, and so it doesn't. So it doesn't create bad behaviour. So I, for example, could say, well, I am going to borrow more than I could possibly afford if I'm reassured that if I can't afford to pay, someone else is going to step in and pay it for me. Then of course you'd ignore the risk. So that is the problem with over regulation, isn't it? Or the central bank is there, and it is always there to step in, like you described. The learning from that will be, I would have thought probably, well, we can take more risks now because if things really go bad, the central bank steps in. So how do you counter that?
That's where Greenspan came in, because when we had the 1987 stock market crash that ridiculously enough, virtually everybody alive has forgotten about except me, when the Dow Jones fell 20% in one day. It's the biggest fall in history. The response to that was what they called the Greenspan put, also having passed rules saying that we don't intervene in the market and let the market work all out for themselves. They saw the market fall 20% in one day, and if they hadn't dived in, vast numbers of the merchant banking system would have collapsed, because one of the few things we've learned and not forgotten from the Great Depression is you don't let banks buy shares. And the reason you don't let them buy shares is that when there is a speculative bubble, and I mean when, not if, when there is a speculative bubble, the banks will rise in value because the rising level of shares will increase their asset side. That will make them look more secure, which will make them more reckless. Yeah. This is reality, okay? And then the stock market crashes, their equity is wiped out in one day. Now, if you go back to 1929, when the stock market crashed by 10% in one day, across that time period between 1992 and 1929, the level of margin debt in America had risen from 2% of GDP, which itself is at the levels we're talking about today, 2 to 4%, risen from 2% to 9%. Now, that with when margin debt back in the 1920s, it was a 10-to-1 leverage. Put down $100,000, buy $1 million worth of shares. One of the other few things we've learned is don't let margin debt get that high. So now the modern rule is you put down 100,000, you can borrow 200,000. So we've gone from a gearing of 10-to-1 to 2-to-1, which isn't quite as unstable. But when that 10% of debt fell, anybody who bought those shares on margin debt was effectively wiped out. You put down $100,000, buy $1 million worth of shares, and then the shares fell by 10% in value. You have $900,000, your equity has been wiped out to zero, and you get a margin call. And the margin call says liquidate anything you've got to bring the value back up to 100,000, which is why we saw photographs of people, speculators in the 1920s, selling Rolls Royces, with literally standing in the street. Give me a few dollars, here's my Rolls Royce.
My heart bleeds for them.
I did. I mean, it was a tragic scene. Yeah, a truly tragic scene. But the banks at that point, when the market fell by 10%, they suffered the same way. So if the shares, let's say they were, pushing up loans and they had a 5% margin, price has fallen 10% one day, the equity collapses by 10%, liabilities remain the same level, they are bankrupt. That's why we've banned. Okay, so that's where the merchant banks came from. And the merchant banks were the ones who were allowed to buy shares. Private banks only buy bonds with the reserves that they had, which were created by government deficit spending, which is another thing that the mainstream does not realize. But the merchant banks could do it now. Now we had my favorite line in On the Brink by Hank Paulson, who was a Secretary of State under the second Bush, and was a person in the hot seat when the 2007 crash occurred, and
For the Treasury,
2008.
yeah.
Treasury, yeah, he was Secretary of the Treasury. He got a call from his successor. I've forgotten which was, of Morgan Stanley or whichever one he came from, but he got a call from his successor saying, "You've got to do something. If you don't act soon, we're going to go bankrupt." And Hank Paulson asked him, "How long have you got?" And the answer was, "About 3 hours."
Yeah.
Okay. Now, in that situation, because back in '87, same rules apply. Greenspan came in and whereas the rules they had said they could rescue banks, but they could not rescue merchant banks. Because the merchant banks were on to failing, Greenspan rescued the merchant banks. And ever since then, supposedly to maintain financial stability, we've been stopping the merchant banks from going bankrupt. That's become a major focus of government policy. Well, you know, the merchant banks are not critical to the functioning of the banking system. We don't have bank accounts of the merchant banks. The merchant banks have bank accounts of the private banks. That's the way the system operates. We could let them fail without destroying the payment system in the same sense that used to happen. The damage would be, collateral damage would destroy the payment system, but not the direct damage.
So this is what we'd call the merchant banks are what we'd call the non-bank lending sector, which is growing quite a lot right now, actually.
Yeah.
And there are red flags being raised about it, because they will lend out money by, exactly like we saw in 2008, where debt is packaged up and then sold to people who provide the money to support that loan. So it's not creating new money like when a bank lends money. It's using existing money. So it's not really helping the economy in any way, is it?
But it's making it more fragile, because if they get involved in lending to speculative activities, and the speculative activities then collapse, then the people who borrowed from them go bankrupt, who can't repay them, and you get the chain reaction side of a financial crisis, which is the only side of the crisis that the mainstream has any real appreciation of. They don't appreciate, and this is again frustration for me beyond belief, they don't appreciate the role of private banks in creating money. They still pretend, and that's the only way I can describe it, they still pretend that banks don't create money. Okay? Now, this is despite the fact that in 2014, the Bank of England, and in 2017, the Bundesbank and the New Zealand central bankers and the Norwegian central bank and several others came out and said, banks do create money. That's in the literature. Now, you'd think, central banks have said it. It's in the published literature. Central bank must have updated their policies. No, they gave the bloody Nobel Prize to Ben Bernanke in 2022 for his work on banking. And as part of that, he talked about banks enabling lending by the ultimate savers and the ultimate borrowers. By ultimate savers, he meant the public. Okay?
Yeah.
They can ignore the major cause of financial crises and then wonder why we have financial crises.
Well, okay, let's come back on that, because there's a quote on that in this paper from Andrew Bailey, the very bank that you're talking about that issued that paper about how money is created through bank lending. So we'll look at that in just a second. Let's take a quick break on the Debunking Economics podcast. So welcome back. Look, a point made by Andrew Bailey in this paper is the impact that the money supply has on the economy as a whole. So you and I have spoken about, if you increase the money supply, then there's more money available to buy stuff, the economy will grow. And in fact, the economy can't grow if you don't increase the money supply. If you reduce the money supply, then there's less money out there for people to buy stuff. It seems fairly simple, doesn't it, to understand that logic? But I'm not sure.
It is simple to understand it, but it's the economists who refuse to understand it. This is what's so frustrating.
Well, so this is what Andrew Bailey says on it. He says the classical view of monetary policy was based on the neutrality of money. In other words, changes in the money supply affect only nominal variables, prices, wages, exchange rates. They do not affect real variables like GDP, employment, investment, and consumption, because money is nothing more than a barter mechanism. So I guess their argument is that if you increase the money supply, then you create inflation, and therefore the net effect is everything's still got the same value. It might cost more, but it's still got the same value, so you are no better off than you were before you increase the money supply. So he does say he agrees that monetary policy can have an effect on output and unemployment and the like, but it's only temporary. And I wonder whether...
Yeah.
Is that the case? I mean, that could be the argument, couldn't it? That if you increase,
I mean, Fred, let's use a technical term here. It's bullshit.
Well, let's follow through his logic before you, and then you pull it apart. His argument, as I understand it, would be to say you added 25% to the supply of money in the country, which would be quite a bold move, so all of a sudden there's 25% more money out there in the country, but your production capability hasn't increased. So it could be inflationary, but maybe your production ability does increase. But by and large, prices are going to rise to try and meet that increase. So you are no better off. That's his argument. That's the way central banks see it.
Let's backtrack. The money supply increases. What increases the money supply? Two domestic things increase the money supply. That is, banks lending out more than they get back in repayments, and the government spending more than it gets back in taxation. Those are the two domestic causes of money supply increase. When the banks lend back, banks create money by creating debt. So if they give you extra money in your bank account to buy that house in Vaucluse, then they increase the money supply and they increase private debt simultaneously. That's one way you create the money supply. The other is the government running a fiscal deficit, as it's called, spending more than it gets back in taxation. Now, according to economists, the former has no effect on the money supply. So even though they talk about controlling the money supply, they think that they're controlling it by changing the interest rate, because they think putting up the interest rate reduces the demand for money and increases the supply. That's the way they reason. They get these two little sticks and they move them around and see where the intersection point is. And they call this, they call that managing the money supply. It has bugger all impact. The real impact is on the willingness of banks to create the money in the first instance. And if there's a boom going on where everybody's expecting, say, a 20% increase in share prices or the same level of house prices, then banks are going to be willing to lend the money and people are going to be willing to borrow it. The interest rate doesn't eliminate that belief that you're going to, if you have a false belief, nonetheless, about the future, but we all have false beliefs about the future, despite the theories of economists. If you believe the price of the financial assets that you're buying with that money are going to rise by 20% and the bank's charging you 5%, you reckon, good deal, I'll take it. It doesn't work as a control mechanism unless you're willing to whack those rates way past the stratosphere, past the level of the rate of consumer price inflation, up to the level of asset price inflation that the financial sector has generated largely by its, casino-like behavior for the last 40 years. When you've got a casino level of return you're expecting, 20-25% per annum in asset prices, forget about people trying to control consumer prices, which are 4 and 5% rates of inflation. It won't work unless you're willing to slam the rates up that high. It's not a control mechanism. It's a brick in the face. Now, I'd wish you're willing to throw it. Otherwise, it's scouring the face to make, improve your complexion somewhat. So we need a realistic theory of how the money crisis was created, and then say, okay, it is true that if you change the volume of the money in the economy, then you will change people's behavior. How could the central bank rapidly change the volume of money in the economy? And that comes down to what they call an unconventional monetary policy, which is quantitative easing. Because when the central bank buys bonds of the non-bank financial institutions, that reduces the money supply. Okay? When it sells bonds to them, it's taking money out. Okay. When it buys bonds, it's pumping money in. So the central bank could use its bond sales as the main mechanism of fighting inflation, but they don't.
Right. Yeah, they don't. And they only use it, as you say, as an extraordinary mechanism at times like when we had COVID. But they, and before, mind you, as well, they were doing it well before COVID, of course. But because they were struggling with what do we do now? Interest rates are down to 0 or minus in some cases. So they were looking at extraordinary measures, which was a surefire sign that the system had broken, wasn't it? But But they would also say, in good times, I guess, that we control the value, the volume of money, because we adjust interest rates. So if we think
Trivial.
more, right?
Yeah.
So the argument that if we lower interest rates more, then the cost of borrowing will be lower. Therefore, more people will borrow. Therefore, that's going to expand the money supply. That doesn't work.
Well, not it
Not enough.
works at such a trivial speed that unless they're willing to smash interest rates, which is what Bockler did. If we go back and look at what Bockler did, and against the inflation at that period, that worked because rates went to 17%, and you had high consumer price inflation at the same time. But it was within QE, is that Aussie expression, within QE of the rate of asset price inflation. Put it up that much, and you're paying 17% for the money or 20% for the money. Holy hell, even if you do have expectations of higher rates of asset price inflation, this slaps you in the face so hard, the asset price inflation stops, and then you get out and the money supply growth does decline because of that incredibly high rate of interest. But it's a clumsy, slow mechanism to go about it when they have a much faster one at their disposal, and that is buying and selling bonds. Now, I would argue that we should rearrange the financial system so the bonds, when they're issued, are sold by the Treasury directly to the central bank. This is heresy in conventional economic thinking, but I think it makes sense when you actually understand the structure of the monetary system. So the government doesn't have to sell bonds to create money. This is, again, one of the myths of the mainstream. They think that the government doesn't create money. They believe that when the government runs a deficit, it reduces the money supply. That's believe it or not, that's the vision of loanable funds. That if the banks, if the government taxes more than it spends in, if it spends more than it takes back in taxes, then it has to borrow the difference from the public. This borrowing the money from the public reduces the amount of money the public sector has and causes demand to fall in what they call crowding out. That's, again, conventional economic thinking. Now, empirically, and friends of mine have done empirical work on this, when you look at it, there is no such thing. There's crowding in. And the reason that crowding in occurs, in other words, when the government runs a deficit, the private sector spends more, not less, is that if the government's doing sensible things like, I don't know, let's say building bridges across a province somewhere that otherwise doesn't have cities communicating with each other because the chasms that separate them physically, geographically, are too big. You've got to drive around them. And of course, I'm thinking of China in this front. You build a bridge and you go from an 8-hour journey to connect to cities to a 2-hour or to a 20-minute journey to connect to cities. Suddenly you have an increase in trade. The private sector says, well, there's the bridge. We're going to build cafes at either end. We're going to build lookout posts. We're going to have a retail section either side of this device. So the private sector spends more when the government spends more.
Yeah.
We have a system which is elastic in various ways. So again, their policies are based on fantasy.
So this paper is called Central Bank Independence in Need of Further Thinking by Andrew Bailey. And he's arguing, obviously, that there needs to be more central bank independence. But I think there's two sides to this, isn't there? On the monetary side, there's the whole maintaining the value of money. And I don't know why that has to be necessarily a role of central banks. His argument given in that paper, which I gave earlier, would be that a government would crumble and just say, well, we need to raise more money, we need to spend more, and so we will because we want to get growth and we're not going to worry too much about inflation. But if the government was charged with both, because they both work together. If they were charged with both, then they'd take on board that responsibility. The fact that they don't means they don't have any responsibility, so they can easily argue, well, we haven't got any growth because the central bank is pushed up interest rates too high, people aren't wanting to borrow, we're not seeing any growth in the economy. Whereas if they had all of responsibility for that, I think control of the stability of the system is a different thing, and maybe that is the role for a central bank. But I wonder whether monetary policy and fiscal policy should actually be part and parcel of the same thing, run by the Treasury.
They should be. And it's only, this is the whole argument that they shouldn't be, is part of a dilemma inside neoclassical economics, which is basically a dilemma amongst people discussing how many angels can stand on the head of a pin. Okay, we've got this. We've got a scholastic academic discipline in control of the practical levers of the economy, and their scholastic arguments are what prevent sensible policy in the first place and ignore the obvious signs of a crisis when they're approaching. And the reason that I don't have a research team of 500 people behind me. I'm not, I'm not going to claim to be blessed with their hand, with the eye of God. But I saw the financial crisis coming because I focused upon something that the central banks ignore, and that's the level of private credit. Okay?
Yeah.
They did not believe that private credit matters at all. That is, again, part of conventional economic theory. For following Minsky's financial instability hypothesis, I see both the level of private debt relative to GDP and its rate of change are absolutely critical indicators. In fact, there's a guy, one of my school crowd, the people that I teach online, Mauricio Pizia, I've mispronounced his name, but he's just started a Substack now where he's using concepts from my approach to economics, which are fundamentally Hyman Minsky, Irving Fisher, the post-Keynesian school in general. He's codified those into an AI, and he's now making like a early problems warning panel concept that he's marketing to people through Substack. And it's using my ideas to say whether a financial crisis is looming or not. Now, apparently, New Zealand's in a fairly bad way on that front. America, not so bad. He's trying to make them for a number of different countries. But because I looked at a different indicator, I saw the crisis coming. And that's why I was warning from December of 2005, as you'd remember, because we were both in Australia at the time. I was saying a crisis is inevitable. It's got to happen at some point, and I was focusing upon the level of private debt. They ignore private debt before the crisis. They haven't modified their theories after the crisis. And this is why they're coming up with these, profound conversations, which are, again, profound disagreements between different groups of a religious sect about how many angels can dance in the head of the pen.
So what about the stability of the banking sector? If the economy is unstable, then the banking sector is going to become unstable, obviously.
Yeah.
But similarly, the banking sector can just as easily make the economy unstable, as we saw, because they issue too much risky debt, and there's the contagion that we saw in 2008, pretty much from that, the packaging up of dodgy mortgages for etc. and the like. That's not a role for government, is it? That has to be the role for a regulator to do that.
Yeah. But again, you need to have central banks that are staffed by realistic individuals. Yeah. And realistic because they've learned a theory based on empirical reality about how the economy operates and not an economic fantasy. But unfortunately, again, it's neoclassical economists who get appointed to these things. Their whole theory is based on fantasies, and they'll put fantasy policies into practice when real ones are needed. So my favorite example there was actually Janet Yellen. She spoke, I've forgotten which one it was, but I think it was either the late 1990s or early 2000s, Jerome Levy Institute conference in honor of Hyman Minsky, the annual Hyman Minsky conference. And at that conference, she waxed lyrical about the impact of the new financial instruments which distribute risk. Credit default swaps, she said, are going to enable the system to self-stabilize.
Mm-hmm.
Well, bang, smash into 2007. She turned up at the 2009 or 2010 conference and made a little sort of curtsy of apology and say, well, obviously I got that wrong the last time round. And she quoted a paper from Minsky. But I had to look at the paper she quoted from Minsky. I'd never heard of it before. It turned out it was a paper in the working archives of the Levy Institute online, almost handwritten, scribbled on a paper and photocopied, not at all an academic paper. And she gave a couple of quotes out of that. Now, she must have told her staff, I've got to talk to this Jerome Levy Institute thing. They think Hyman Minsky matters. Find me a couple of quotes from Hyman Minsky you can give me that I can put in the paper.
Yeah.
Okay. I think that's what she did, okay? Again, it's just this fantasy stuff that central banks have gotten away with through the last financial crisis. In the end, they're still doing it.
If we weren't reliant on them, though, for monetary policy, if we said, well, okay, monetary policy in whatever form, policy on stabilizing the value of money and getting and allowing for growth should all be the role of the government. ensuring that banks aren't contributing to the instability through their behaviors is not a government role, because, for example, it's almost like law enforcement, wouldn't it? It'd almost be like the police, particularly if you had to go after a particular company. So microprudential policy you can't put in the hands of the Treasury. So if you put all of that in the hands of the central bank, then that makes perfect sense. And then that just becomes almost, and they can build models to try and, or algorithms to try and look at how bank behavior is influencing the instability of the banking system without having to worry, and in the light of whatever the government policy is for money supply or taxation or whatever other instruments that they're using, then that becomes a more mechanical, methodical way, and they would not be lobbied by, well, they probably would be lobbied by outside interests, but not voting interests, because nobody's voting for them.
Yeah.
So it's basically the police of the banking system. That makes a great deal of sense, doesn't it?
It should. But you need to understand how the system functions. And if you start from a set of papers, the set of arguments about money, money neutrality, policy ineffectiveness proposition, rational expectations, what the hell are you going to come up with except from a fantasy that, you should be reading to your child at night to get her to sleep, not using it to manage the economy? So the tools are there. The structure exists for the banks to have some capacity to manage the money supply, while also having some capacity to control outrageous behavior of financial profligates, projectors, and as they used to be called. Yeah, you could do it. We've got a bunch of, they're not morons, they're educated idiots. One of my next door neighbors once described academics as educated idiots. And they're educated idiots using a toy model that has no relevance to the real world,
they've got a set way of thinking.
Inflation.
So you've got a set way of thinking. So actually what you need is to actually say, well, okay, we need to have more of a duality of thinking. We need to have a wider range of opinions in here rather than the established way of opinions.
We need realistic models for our central banks. And at the moment, they're still using neoclassical models. After they've failed and failed and failed and failed and failed, we're still wondering why the system doesn't work.
And the regulation
the wrong model.
The regulation needs to focus more on the non-bank lending sector than the bank sector itself, doesn't it? I mean, the more you regulate the banks, which is what is happening now, the more you regulate the banks, more people turn to the non-bank lending sector to try and generate.
And that's been a part of history as well. And you've got to be cautious of letting it happen rather than welcoming it. And of course, so Janet Yellen's speech back in the first one she made at the Levy Institute, welcoming credit default swaps. Well, why? Because these are designed by the same people who believe that money is in neutrality. So again, it's bad theory getting in the way of practically sensible results. And I appreciate Bailey's desire to do something different, but get outside the neoclassical envelope. Learn what the post-Keynesians and realistic people have said about how the money supply works. I'm actually looking at the history of the performance of the central banks and the money supply, and it tells you can't control this just using interest rate.
Well, you won't like his conclusion, right? Let me read the last paragraph, because a big part of his argument is when you're looking at financial stability, you should be looking in the same way as you're looking at the value of money, maintaining the value of money with monetary policy. The approach for financial stability should have the same objective around maintaining the value of money. He says, I see a merit in creating a single overarching narrative with a strong focus on the value of money. It would remove descriptions of financial stability such as tangential or in conflict. Even more important, it would help to anchor financial stability by emphasizing the importance of the value of money. This is important because independence in respect of financial stability is otherwise not as robust, and I would argue not robust enough. So in other words, he's tying the role of financial stability and how you measure it based on the value of money.
Yeah. And this obsession with creating a zero interest rate, using policies that don't have a direct impact upon the interest rate, is still thinking inside this neoclassical envelope. It just shows how persistent these wrong ideas are. They can't get them out of their head. These are all the policies just continue doing what the textbook says, and one of these days it's going to work.
Do you know what? We just got through half an hour, so we didn't mention Iran. Isn't that fantastic in this day and
Oh, a
age?
wonderful relief. I'm sure they'll feel so much liberated. But talking about that particular phase of madness.
That war. All right, very good. Well, I will talk to you wherever you are and wherever I am next week, Steve.
Okay, mate. See you then.